As we dive into the heart of the stock market's current turmoil, it's crucial to understand the profound impact of recent events that have led to a sharp decline. The market isn't witnessing a full-blown crash just yet. Instead, we're experiencing a market correction, a term that signifies a downturn of 10% or more from recent highs. The S&P 500 has dropped by 2.65%, and the NASDAQ 100 has seen a near 5% dip. These figures highlight the turbulent waters that investors are navigating right now, and they hint at uncertainty in the economic landscape. A significant contributor to this decline is waning consumer confidence. For 3 consecutive months, U.S. consumers have shown diminishing optimism about the economy. Concerns about inflation and tariffs have begun to creep into household wallets, leading to hesitation in spending. This ultimately reduces corporate earnings, particularly for industries reliant on robust consumer activity such as retail, travel, and technology. With consumer spending in jeopardy, the ripples of fear are being felt across stock prices. Moreover, the tech sector, once a beacon of growth, is now undergoing a critical slowdown. The high-growth tech stocks, which previously fueled the market's ascent, are now facing scrutiny as investors react to high valuations and anticipated slower growth. Even the once booming AI stocks have begun to falter as profit-taking sets in. The NASDAQ, heavily weighted with tech companies, reveals a concerning trend, as names like Palantir witness declines of around 30%, further tightening the noose of uncertainty around investors' necks. This market behavior raises the question, is this a temporary dip, or are we at the precipice of something much larger? While the landscape is filled with uncertainties, savvy investors recognize these turbulent times as potential opportunities. The key lies in assessment and strategy, staying informed about market movements, applying patience, and identifying undervalued stocks can position investors favorably for the long run. As the market corrects itself, those willing to endure the storms may find themselves well-positioned as recovery begins. In essence, opportunities often arise from volatility, and strategic investment can yield significant long-term rewards amidst this chaos. In a landscape marked by trade tensions and the specter of tariffs, understanding the ripple effects is crucial for investors. Recently, the U.S. government's announcement to raise tariffs on imports from Canada and Mexico has thrown a wrench into investor sentiment. The hesitation stemming from potential trade retaliation is not just a statistic. It's a palpable concern that seeps into market dynamics, causing investors to tread lightly amid this uncertainty. The impact of tariffs extends deeper than mere headlines. Companies that rely on imported goods face higher operational costs, leading to a trickle-down effect on pricing. As businesses grapple with these increased expenses, the likelihood of passing these costs onto consumers escalates, stoking inflation further. This complex web of economic factors heightens the stakes for the Federal Reserve, which is closely monitoring inflation expectations while considering interest rate policies that could either stabilize or further destabilize the economy. The looming question remains, how will market psychology react to these developments? Emotional selling, often born from fear, has started to grip investors, leading to a surge in panic selling. As bad news circulates, the psychological domino effect takes hold. One investor's decision to sell will often prompt another, amplifying the downward spiral of stock prices. This scenario is exacerbated by stop-loss orders activating at critical price levels, creating an environment where the illusion of a massive market sell-off can lead to significant losses. Despite the prevailing fears, history reminds us that market downturns are not uncommon. From global sell-offs to unforeseen pandemics, each year brings a new set of obstacles for investors. Nevertheless, the long-term trajectory of the S&P 500 reveals resilience. It has delivered substantial returns over the last decade, even amidst these challenges. This underscores the importance of maintaining a perspective that can sift through the short-term noise and focus on long-term gains. Investors must tailor their strategies in accordance with their timelines. Long-term investors are encouraged to stay the course, remembering that corrections can present valuable buying opportunities within a fundamentally strong market. Conversely, short-term investors aiming to preserve capital should reconsider their positions in volatile equities and consider safer high-yield alternatives. In times of uncertainty, aligning investment strategies with individual financial goals becomes imperative, empowering investors to navigate the choppy waters ahead. In today's unpredictable market, portfolio diversification is key to managing risk and ensuring stability. The three-fund portfolio strategy, comprising a mix of stocks, bonds, and other assets, allows investors to reduce volatility and cushion against market shocks. This strategic allocation provides a balanced approach to growth and safety, catering to diverse financial goals and risk appetites. When navigating market turbulence, choosing the right stocks becomes crucial. Companies like Microsoft, Palantir, and Berkshire Hathaway have emerged as top picks, particularly during dips in the market. With only 10% of a well-diversified portfolio allocated to individual stocks, investors can achieve significant gains while keeping their overall risk manageable. This intentional strategy not only offers potential rewards, but also safeguards against the dangers of overconcentration in volatile equities. Expert opinions on the market recovery indicate a strong potential for rebound, particularly from analysts like Tom Lee. Short-term fluctuations may instill fear. However, they can also present opportunities for strategic buying. Investors holding cash on the sidelines are likely to re-enter, fueling upward momentum in stock prices. Moreover, if hiring slows down, it could prompt the Federal Reserve to cut interest rates sooner, another factor that may provide a lift to the market. The current market correction should not be viewed as a harbinger of doom, but rather as a necessary fluctuation in the economic cycle. Investors need to remain calm and rational, steering clear of panic selling driven solely by emotions. The silver lining in a market dip is that high-quality stocks are available at discounted prices, allowing for smart investments with long-term growth potential. Embracing this perspective can enable investors to build wealth steadily over time without succumbing to fear-based decisions. In conclusion, a well-structured portfolio focused on diversification will help weather the storm of current market conditions. Long-term investors should continue to engage with the markets, always keeping their sights on future potential rather than short-lived volatility. Those needing liquidity in the near term should maintain a conservative position in safer assets. By adhering to a disciplined investment strategy, the journey through market fluctuations can transform into a path for lucrative opportunities. Remember to invest wisely and stay the course.